Welcome to the Prime Property Finance Podcast with Gareth Morgan and Mark Watts. This unique podcast will dive deep into all areas of property investing finance, going behind the scenes with property professionals, investors and clients. Between us, we have 35 plus years experience in property finance. The podcast has been launched to share knowledge, mindset requirements and experiences of successful investors and professionals. We aim to simplify many of the complicated areas of finance and investing and provide valuable and easy to implement tips. Keep an eye out for our new longer episodes every Tuesday and our shorter ones every Friday.
Hello and welcome to this week's episode of the Prime Property Finance Podcast. My name is Mark and today I've got with me Stephen Todd, who is the co-founder of VAS Panel. For those of you who have done mortgages, probably very familiar with the words VAS Panel and what they actually do, but thought it'd be fantastic to bring Stephen on to the podcast, explain to us a little bit around VAS Panel, and more importantly, they've obviously got significant insight to valuations, instructions, and all of that sort of stuff. So welcome, Stephen.
Hi, Mark. Thank you very much for having me.
You're very welcome, and thanks for joining us. So let's get straight into it then, I guess. Do you want to just give us a quick introduction of yourself and how VAS Panel came to be?
Yeah, my name is Stephen Todd. I'm co-founder and Chief Commercial Officer of VAS. Business has been going about 10 years now, and I think my business partner, Gina, and I sort of had the idea of the business. My background's very much valuations. I've been a chartered surveyor for 20 years and sort of reviewing valuations. So reviewed an awful lot of reports from different firms all over the country, so we knew we could build a really good valuation panel. So we did. We started the business 10 years ago, and it's grown rapidly, really, into the market, and predominantly working in the short-term specialist challenger bank market, and which is, as everyone's seen, it's grown dramatically over the last 10 to 15 years. So yeah, it's been a busy ride, let's put it that way, over the last 10 years.
Yeah, fantastic. And with regards to, so just for the purposes of the audience then, in regards to panel management, can you just explain what that actually means and the problem that you're solving for lenders, I guess?
Yeah, so we've built a valuation panel of about just over 200 firms, from national big firms that everyone will have heard of to larger regional firms and smaller local established firms. And I think the panel business and panel businesses in general are becoming increasingly popular because there's so many new lenders into the market that are lending against all different property sectors in all different parts of the country. To do that, you need a really, really sort of large and diverse panel. And to do that directly internally from a lender is really difficult. So I think that's the problem we've solved, I think. And I think doing it in a, making sure the valuations come back in the time that they said they're going to come back, and making sure the quality reports and done in line with lender's instructions. So whilst VAS is primarily around having a big panel, quality panel, it's about getting the reports back on time and doing it in line with, which I'm sure we'll come on to talk about, but in line with the lender's requirements. Every lender has different requirements. So I think the technology we've built, we've got quite a large level of control there, so which lenders like. So again, probably one of the main reasons why we've grown so much in the last 10 years since we started.
Yeah, and it's interesting. We often have conversation with clients around the perception, I guess, from borrowers is it's the lender's valuer, which is true in certain instances, as in it's their own smaller panel. It's not their own valuer, but they have their own pre-approved panel. But the beauty of obviously working with yourselves, it is truly independent of the lender. So, they have little control over where it goes. It's genuinely third-party, arm's length, no influence, etc., which I think some of the borrowers perhaps don't quite understand, that it is a genuine valuation, not something the lender wants.
Yeah, the panel very much it's our panel. All the values that we've got on there are on there on merit that we've added. Some lenders might choose not to work with certain valuers, and our technology allows us to do that, so we won't go out to quotes, but essentially we work on a 25 to 30 mile radius of where the property is, and if there's got to be a valuer within that region. We offer a minimum of 3 quotes as well. So if it is independent, and like I said, some of the investors that you work with who could be listening will get a different level of choice essentially, which is really important.
Yeah, and the other thing we've found that works quite well is a degree of control. So if you've already got a relationship with a valuer in your area that you've worked with in the past and they know you, etc., they know the area, then you've got a degree of control over whether you can instruct them officially. Also, the fact it comes back with free quotes, you're in control of which quote you use based on their SLAs, urgency and all of these sorts of things. So that's another piece which I think clients like, is that they can actually select from the shortlist, if you like, as to which best suits their needs.
Yeah, I think so. If we've gone out based on the technology and the valuers we've got on the panel for their specific sectors. So if a firm does come up that we're happy to go to, and your customer might know them, then that's part and parcel of what we do. So sometimes it works like that. Sometimes again, the investors might not know who any of the firms that we've offered for a quote to them.
Yeah. And then one other thing then that appears on the quotes, which people will see when they get the VAS, the quotes off us or direct to themselves, is around the PI cover, the professional indemnity insurance. Do you just want to, because it's something that gets spoken about briefly in our sector with the finance, but do you want to just cover off what that actually means?
Yeah, I mean, all valuers have got a certain level of PI. Nearly everyone's got a minimum of £1 million. Some go up to, some of the national firms were up to £200 million. Some valuers choose to give us the whole amount. Some decide, and the RICS are increasingly encouraging firms to do this, to restrict it on a level of the percentage of market value. So some firms on our panel, when you see a quote, you might see 65%, 75% of market value, or a certain number, whichever is the lower. So some firms are going down that route. But at VAS, what we do is try and match the level of PI with the estimated value of the property. So we know that the lenders are getting the right level of PI essentially against roughly where the value is.
Yeah, and I think it's important then that the PI is mentioned, because it justifies the fees associated with surveying and valuing properties. So the fact that there's recourse back to the valuer in the event of default, and they can't recover the proceeds because the valuation was significantly under what was valued, etc. And therefore, every time a valuer values a property, they put themselves on risk. Hence the fees. That's what you're paying for, really, is not just the professional opinion of the valuer, but also the fact that there's a recourse back to the lender, which the borrower doesn't necessarily see.
I think fees are quoted on for various reasons: the complexity of the property, time it's going to take to do it, etc. Obviously, there is PI involved with the valuer. I mean, it's it is madness sometimes, I think, in this country, where a valuer might charge a couple of thousand to value a property, and they're putting £5 million of cover on the line. So the valuers do live in it is a high risk environment for them. See, in America, they work on a percentage of PIs given to a lender based on a multiple of the fee. So if they are charged £2,000, you get $10,000 of cover. And I think in Australia they've done away with it altogether. So we are the way this country works in terms of its PI. It's been there for a long time. I can't see it changing anytime soon. But one thing I would say about the PI market, though, is it was the amount of insurers, especially around COVID time, really reduced. So the valuers have had a really tough time. The premiums it costs the valuers to pay for the PI is huge now. So the valuers they're in a competitive environment of quoting, and then their insurance does cost them a lot of money.
Yeah, and we saw that in our space. The number of PI providers shrunk massively, as you say, through COVID. Solicitors are in the same boat, so people complain about independent legal advice, but obviously they're going on risk every time they actually give that advice, and so on and so forth. So I think that's enough about PI. Otherwise, we'll send all our listeners to sleep.
The whole section about it. Yeah.
Yeah. Let's get down to the actual bits that people are tuning in to listen to. So, in regards to valuations, then, I think a great place to start is at the very beginning, when we issue the instructions. So the lender will instruct or send an instruction through to VAS, and then that instruction will find its way to the actual valuer themselves. Do you just want to go through the different types of instructions that can be received, and what and why they differ, I guess? Yeah,
every lender's got a different. A lot of them are quite similar, but there are some nuances to all of them, especially on the basis of valuation. Some lenders ask for like market value in a sort of restricted marketing period of say 180 days, 6 months, and maybe VP. Some ask for market value, then VP value, VP 180. So every lender's, and it's all about their sort of risk profile, like what number they're going to lend off essentially. And there's other things regarding around how you approach portfolios, hope value, things like that, how lenders want HMOs to be looked at, which is a grey area of valuation, I'd say. So it's there are different nuances in the lender's instructions, which I'd always encourage your sort of people listening to really understand that, because it's important.
Yeah, absolutely. Because I think that obviously, depending on the question you ask, will determine what the answer you get. And by that I mean, if you have a lender, let's take bridging finance for example. It's classic in bridging finance that people quote 75% loan to value. It's understanding, yes, but what value are you actually working off? Is that the open market value? Is it going to be the 180-day or the 90-day valuation? Because those are going to have different figures that come back, and you're 75% of a very differing number, which could fundamentally break the deal. So it's less common, I suspect. Well, it is less common in terms of mortgages off that basis.
Yeah, market value and sort of 180 figure and VP for residential are generally very similar. Level of discount put on those is quite small, if not, it should be. Well, my view on residential, if there's lots of chimney pots around and things are readily saleable, they shouldn't differ in terms of a 180. Commercial properties, the more complex, the more remote they're located, the discounts can be much higher than 180 and 90. I think simple sort of story I use is he could have a shop let for £10,000 a year, and the let market value could be worth 100,000. VP 90-day could be worth 70,000. So the valuer's done the exact same approach, but you got 30% swing of values. And I suppose if you're wanting, if you think property's worth 100 grand and you need to borrow 75,000, if that specific lender's off VP 90, then you're not going to get near it on a lending side. So it's really important, very simple but important to understand.
Yeah, and we see it in the valuation reports as well. So I took a recent one that we've just done. The instruction included 4 different questions: market value with the benefit of its leases, i.e. the yield-based value, the vacant possession value, so assuming that the property was empty and bricks and mortar, as others may refer to it. You've got the 180-day value on a vacant possession and the 90-day value on a vacant possession. So there were 4 instructions that were, or the 4 questions that are on there. And I guess to explain that is very often if there is a significant swing between the 180-day or the 90-day versus the open market value, that may encourage an underwriter to perhaps ratchet down their loan to value, depending on or understand why that is such an outlier in terms of, and it's usually, as you say, reserved more for niche properties, if it's a care home or, as you say, commercial and that sort of stuff. You tend not to see it in resi. But it just to explain that helps the underwriter to understand where its credit risk sits in terms of what LTV it wants to lend. I know we all want the higher number, but sometimes the sensible thing is if that 90-day, let's say, is the 30% swing, they might come back and say rather than 75%, we'll only do 70% due to the difference between those two numbers.
Yeah, it's a risk appetite of the lender as well. So, and if in simple terms, I suppose if they have to take possession of it in the future, they don't want to have to wait sort of 12, 24 months or to have to sell it. So similar portfolios, like if a large number of properties in a portfolio, to sell them all individually, it takes a serious amount of time. So they'll lend off a sort of a little bit more conservative number, I suppose.
Yeah, and like it's difficult to know that from the outset as well, because until you get the report back, you just don't truly know what you're dealing with. You can only make assumptions pre-report. So with the best will in the world, you all say 75% and you're going to get this and that, but ultimately, until you got the report in your hands, that's why offers are normally, when you offer, it's after the event, after the report is received. A lot of lenders will want to underwrite whilst the offer's being sent off, and many borrowers are nervous of that in so much they want to be underwritten first and then go to valuation report and so on.
I think that's in some, especially higher value cases where like maybe getting a desktop valuation in advance, maybe from a firm that's on a lender's panel or our panel, just to get a bit of advice, and it's often cheaper. But I think like if you can get a desktop and give the valuer enough information up front, then you roughly know where you're going to come out. So I think it lowers sort of nervousness around where the numbers are going to come out and how they're going to approach it.
Yeah, and the other thing as well, I guess, is there's the distinction between purchase and refinance. So in terms of purchase, it's quite prescribed, as in that's the figure you're buying it for. So theoretically, that should be its value. Sometimes it's not valued the same, and that is ammunition for you as the buyer to perhaps go back and renegotiate with the seller if that's the case. I guess where we're seeing these differences are more around the refinance element, where people are now making assumptions on current values without the benefit of it's being listed for X value.
Yeah, if the property hasn't been transacted for a significant period of time, then it comes more down to comparables of the similar things that have sold in the area. And if the lack of comparables, you are using the valuer's sentiment. I suppose that's why local market knowledge is absolutely key, and making sure you've got a company close by that really understand the market and how that property sits into the market, which panel management side of things, it's really like local market knowledge of the valuers is really important.
Yeah. No, I couldn't agree more. Okay, so fantastic on that front. So the instructions, as you say, you'll tend to see that if you have, and there are different types of valuations as well. So you've got the short form and the long form valuation. Just want to go into a little bit as to what the difference is between the two are?
Yeah, I think the short form is, it's probably our terminology at VAS, we call it the short form, but the residential mortgage market, often on Quest, they use a residential property to valued on a more simplified form, essentially, which is a smaller template. We've got access to Quest through VAS, and we're automated with some of the valuation firms we work with. So that's essentially what we call the short form. Long form is the valuer's own full loan security, thicker report, essentially. So we try to get sort of more basic, simpler on the short form residential. We do have we introduced and designed a sort of smaller HMO template, so a bit easier for the buyers to fill in and a bit more cost effective for customers as well, rather than valuers needing to fill out their full report template. They can do it on the prescribed one that we give them, and it does save them a bit of time.
Yeah, we see that as well. Well, if you've ever had a short form versus a long form, there is a material difference in what's contained within those reports. The one that we had in last week was 114 pages, I think. Probably, I reckon, about 10 or 15 of those pages were the instruction letter itself. And they're actually quite useful if you get a long form. If you're interested and you plan on doing multiple refinancing, actually taking the time to read your report is valuable. There's a lot of lessons in how that process works, and you can physically see the instruction letter on the back to see what the questions are, and that should help you understand why the things have turned out the way they have within that. Long forms are,
the more complicated the property, the more you need to write about planning and the building in general and tenancies. So, that can't be put on a short form template. So it needs to be the valuer's long form. But the RICS through the Red Book, which I'm sure all your listeners have heard about, is, the RICS doesn't tell valuers how to value. They give a minimum level of things that are needed in reports. So all the long form reports follow the exact same. Everyone's report follow the same. It's because the minimum requirements are set by the RICS, so it's essentially following that.
Yeah, and that's a good point as well around that each property is, whilst there are templates and there are common ways to value things, the methodology itself is not prescribed. It's down to the valuer, once they see the property, to apply the best method of valuation.
Yeah, there's five methods. So the investment method if something's let, comparison if it's vacant, residual, which is for valuing developments, profits method for properties that are trading properties, and depreciated replacement cost, which is like things like lighthouses that don't have any intrinsic value unless for the purpose that they're there for. So they've got to pick from one of the five, essentially, and it's up for them to pick the right one, essentially.
Yeah, and I guess therein lies some of the challenge around, where clients say, how are they going to value it? Well, until the valuer sees the property and what exactly, yes, we know it's an investment and we know it's likely to be this. So along with the valuation instruction, plus the methodology, then that could alter the outcome of it. And that's perhaps the bit that's difficult to try and predict in many respects. So
Yeah, I think having a chat with a valuer up front to see how they'd approach it and things like that could be useful because, valuers do want to chat to people and they're happy to, to answer questions and sort of their logic of how they're going to approach it. So the valuers are generally more than happy to explain that and talk people through it.
And on that basis, then, a lot of people are encouraged to create valuation packs, obviously to do the comparables work and perhaps before and after photos if you've done refurb on the property to show what you've done to it and so on. How much weight do they actually hold and how well received are they by valuers, or are they just a case of, look, just leave me do this, it's my job? I mean, we tend to get mixed feedback. What's your take on it?
I think if one of your customers is a keen investor who knows an area really well, knows everything that's sold, I think there's a hierarchy of evidence, from the RICS and sold evidence that's been openly marketed. So arm's length transaction, properly marketed, no sort of into family sort of sale or anything like that. So, that's the best evidence. So if they do have that to hand and they know it, then I'd definitely offer that up to the valuer just in case that. I mean, some things like HMOs are incredibly hard to get comparable evidence. So, if you do have it and it's sold, and give the details of the agent and what it's sold for and to the valuer. And I think that would be really helpful to them.
Yeah. Okay. And again, it's up to them whether they choose to use that evidence, isn't it, or whether they go away and source their own.
Well, they'll always source their own, and then they'll also always source the validity of that have been given. But so sometimes they do miss comps, and it's just like, it's I wouldn't say it's a mistake, but trying to find these is quite challenging. So if something's actually sold and the details around the property and what it is, where it is, how long it was on the market for, all that's really useful.
Yeah, and I guess then the value of that evidence gets stronger the more niche the property. If it's a standard resi, 2 up, 2 down, that's probably going to be a lot easier for a surveyor to find the evidence. Whereas if you are, as you say, you've got a 10-bed HMO and there are very few of them around, then if you've got comparable evidence to give to help, then that's probably going to be better received because, it gets them on the front foot.
Yeah, absolutely.
Yeah. Okay. So, and anything else that you think in terms of valuation reports? I mentioned before and after pictures. Anything else you think that's of value to include in those sorts of packs, if you like, that tend to get handed to valuers? Anything else would be useful? Comparables,
if they've done work to the property, like what they've done, how much they've spent on it. I think if it's a purchase, and I think this is a sort of grey area as well, but if a property is being purchased and you believe you're buying it for below market value, I'd really tell the valuer why you think it's below market value. I think that's really important because it's hard for a valuer if they see that something's been bought, say, for £100,000 and you think it's worth 120. And there's a lack of comparables around there. Understanding that sales process is really important. So I think if there is a story to tell around that sales process and how you bought it, etc., then I'd tell them that as well.
Yeah, and below market value is an interesting one. I was going to ask that previous, actually, was in terms of what your definition is of below market value, I guess. How do you see that? Because that differs obviously in terms of the buyer versus what lenders deemed to be below market value and also valuers. So what would you say is your definition of a below market value?
No, I think if you approach someone who owns a property and want to buy it off them and off the market and it's not being tested and someone's going to give you a bit of a discount, you can get discounts if you buy in bulk, if you buy portfolios, things like that, then I think that is definitely worthy of telling them why. I mean, if a property's been bought for 100,000, it's been openly marketed for 4 months, and there's been 5 offers, and there's 5 offers around there, and you think it's worth 20,000 more, then it's very hard to justify that. I think I'm sure we'll get on to estimated versus actual values, but across our entire business, we track all that information as well. So it's definitely an interesting statistic. I think across the whole business, it's about 12 to 13% roughly difference between market and actual value. So it's if your customer thinks they've bought it for a good deal, then definitely provide the story around why they do think that.
Yeah. Okay. Yeah, that's useful. And you mentioned then, perfect segue into estimated versus actual. And you mentioned it's approximately 12% difference between what the actual value is versus the estimate. So the actual is lower by 12% than the estimate, as opposed to the other way around. And do you have the figures where that's split between purchase and refinance, or is that primarily on the refinance side?
Yeah, we could have. That's just across the whole business. So we could. I haven't cut that data, but we could cut that data to see what the difference is there. But I think we at VAS we're doing around 30,000 valuations a year. So I think it's an interesting story that we've got sort of probably 2,000 individual valuers doing work across all of that. So they can't all be doom and gloom and down valuing. It's all of them. It's I think sort of my analogy is generally if someone thinks a property's worth 100,000 and the market goes up 5%, then they'll tell everyone it's worth 105. But if it goes down 5%, they'll still say it's worth 100. But I think what's encouraging for us is that percentage was wider up to 6 months ago, and it's starting to contract a bit and come further in, which shows that the market is improving a little bit and getting stronger, which is a positive sign for everyone.
Or conversely, it could be that seller or people who own property be more realistic.
Yeah, potentially
in terms of values, and that may be because of just experience and what people are seeing is just starting to get, because we went through that piece, didn't we, in COVID, where values just went wild, and things we're 3 years beyond that now, or 2 years beyond that, and things have settled back down. So perhaps expectations are now starting to calm back down again, whereas people were assuming it was 10, 15, 20% growth, which 3 years ago was probably not a bad shout. Now it's more like your 3s and 4s and 5% growth, if growth at all.
I think so. It's hard for us to know. I think collecting the data does help us spot trends in the market. It's something as a business we're trying to get better at. And I think we were at an event recently where we in South Wales, where we looked at how the South Wales sort of data compared to overall market data, which is really interesting. So as a business, we know that we need to get a bit better at that. I think doing our day job is it's busy enough, and we know we appreciate that the data we've got. People want to understand what's happening in the market, and hopefully we'll be in a position soon to sort of give that information out a bit more.
Yeah, no, and that's interesting, and certainly from an investor led, in fact, from a home buyer, I guess, isn't it? Because you want to, ideally, I suppose, outside of schools and everything like that, you hopefully would see your home increase in value over time. It's not always true, depending on where you are and what you pay for it going forward. So data, is key to that stuff.
I think so. Well, a lot of lenders with their loan books, they benchmark the residential values to the Halifax index. They publish a good index to the Halifax about what's happening in the market. There's not a lot of those indices in the commercial world, especially HMO market. The MSCI do indices that they try to benchmark them against, but it's much harder to predict that sort of commercial side of the market than it is the residential.
Yeah, no, definitely. And we spoke about this beforehand as well, and you mentioned HMOs there. So HMOs, we certainly are feeling that is becoming more popular as people are moving for better yielding properties, because margins are getting squeezed. If you're going to be in property, then there's the whole buy-to-let is dead. That's an entirely different conversation, but a lot of people are migrating over to HMO to get better returns and so on. Is that a trend that you're sort of seeing? Because that's certainly what we feel.
Yeah, definitely. Over the last 2 years, what sort of has taken us by surprise, hence the short form HMO template that we created. I think as interest rates started to go up quite rapidly from the sort of record levels of being at for so long, I think people had built portfolio, but especially buy-to-let portfolios in a low interest sort of environment. And then, if you're unlucky with your timing, like you said, the margins have been squeezed on those significantly. So I think what we saw is a lot of investors trying to see what they could do with the properties to get a better return, and a lot of converted HMOs into buy-to-lets into HMOs. It's interesting. I think out of 80% of all the HMOs we value are all for refinancing purposes, so very little of them are for actual purchases. So I think people are converting them. So that's definitely a cornerstone of the market. I'm not sure, interest rates have come down a bit now, so whether that cools off a little bit. But HMOs definitely has been sort of a strong sector. I think semi-commercial as well. I think again, whilst investors are looking, they understand residential, comfortable with it, so you might have a flat upstairs, but like a ground floor of commercial or whatever, where you're going to get maybe a 10% return across the commercial and a 6 on the residential. You get a blend of, say, 8, which is still quite, still good and still make money out of that, essentially, even in the higher interest rate environment. So semi-commercial as well is definitely a sector we've seen significant more volumes in.
Yeah, and I think because of the mixed-use nature of the property, it de-risks, so it has the potential for greater yields. However, it de-risks it in so much that let's take the high street, for example, you've got a retail unit on the ground floor, two flats above. Ultimately, if the 2 flats above cover the rental income plus a small margin without the ground floor being let, then at least it wipes its own face in the short term. And then, with the ground floor having hopefully a better yield, that could push the number up. So I think more people are going in there with that sort of, it semi-de-risks, but allows you to put a toe in that commercial space.
Yeah, I think so. And so we noticed it because we had a huge spike in post-valuation queries in PVQs, and it was around lenders asking the percentage of floor space with residential and commercial, because the amount of extra semi-commercial we were doing. So again, that's going back to the lender's instructions. It's the percentage of sort of residential versus commercial as well. That's a really important part for them.
Yeah, and great that you bring that up, actually, that 60-40 split. So what we're seeing is lenders who are not commercial lenders. So they're not like your Shawbrook Bank, who can do semi-commercial resi, HMO with a lot. These are more like your foundations, your HTBs of the world, who will do semi-commercial, but they need that split to be 60-40, so it still falls under the residential banner. And that's, both in value and in terms of floor space. And that can be quite hard sometimes in if it's borderline and it trips over that border, then the lender can't proceed on our side. So yeah, that is something to be very aware of. So we're not just asking to be awkward, we're asking because if it's the wrong side of that split, the lender just simply can't proceed because they're not commercial lenders.
Yeah, some lenders ask for it by floor space, and some lenders ask for it by value. So it's an artificial cut of the value, essentially, because sometimes you value these things as one. So it is a bit of a challenge for the valuers as well.
Yeah, and one of the lenders also wanted by rental split as well. So 3 times you've got to test the 60-40 just to see if it will fit into their particular criteria, which, again, can be difficult.
Yeah, and I think sort of through VAS, with the instructions and how we work, we can make sure we check that, not only the values are provided and the split in the floor areas or the split in value between the two. We can also make sure the split in terms of, normally the market rent is separated out for the commercial and element bit and then added together, essentially. So that is normally openly available in the reports.
Yeah. It just makes our job quite challenging in certain instances where you want to, because the rates for some of these lenders in the semi-commercial are really competitive. But the reason they can charge what they are is because it has to fit a very definite criteria in order to fit into their, dare I say it, specialist resi effectively, as opposed to a semi-commercial product. Yeah,
I think if you know the floor areas and the split between the commercial and residential and percentage between the two, then that's quite a useful guide potentially. So if you've got the estimated value, able to split it that way. It depends how the valuer's approached it. Again, maybe a conversation with the valuer in advance about how they're going to approach it. Again, just so you don't get caught out at the back end. Yeah, definitely. And because we tend to then default, if it's borderline, we'll default to a lender that can cater for commercial. So if it does fall outside of the splits for any reason, it's not a no, it goes on to a different product. Yeah, rather than moving lenders. Priced. Exactly. So at least you don't lose the valuation money back of that. So speaking of which, actually, that leads me to retypes. So we get asked a lot around, can we reuse the valuation report with another lender, etc. Do you just want to talk us through retypes and when they are actually appropriate or not appropriate? Yeah, well, it's we obviously get that a lot within the business. I suppose if VAS have done it before, do we work with that other lender that you wanted to retype for? If we do, then great. We do have a bit on our dashboard where you can pick the readdress. We can even do readdresses of non-VAS reports. I think we do sort of see challenges on the fees that sometimes these things cost. Nothing's ever sort of a readdress, and then coming back to the sort of the lender's instructions again. You're not just readdressing the report from one lender to another. This other lender, the second lender, might, I guess, have different basis of valuations and different ways they're wanting to approach it. So the valuer's having to open the valuation back up again and redo what this new lender wants. So it's very rarely just, they call it a retype, and it's like this industry's got a certain thing, cash value, vacant possession value, all those kind of things that the industry uses. But yeah, retypes can cost a little bit more than some customers would expect, but it is for those reasons where lenders do require different things in their instructions versus the previous lender.
Yeah, and that's good to know, because as you say, a lot of people just think they can just take that one valuation report with all, let's say it's a long form, it's one of these 120-page long valuation reports, and just want to present that to a different lender rather than the one it was originally instructed for. And I think there's probably an underappreciation that it's just not changing the name and addressing it to a new lender. As you say, there's a new instruction you've got to line it up with. Okay, in certain instances, you may be fortunate. There may be minimal, if not no, updates, and we can just use, because the instruction is the same. But invariably, there will be a slight difference because the new lender will underwrite slightly differently. There'll be nuance in there.
Yeah, and the value will just price because of the time it's going to take them to have to open the report up, and might take them an hour, 2 hours, might take them a whole day sometimes. They've got to work new numbers out as well. So that's generally why you sort of seem to get sort of varying different fees for these retypes.
Yeah, no, and so that's a really important point as well, because it's not perceived that way for sure. It's not, this 150 quid should cover it, and it's like, well, actually no.
Yeah. I think on the residential short forms, that's much cheaper, very quick. But the list of long forms, commercial properties.
And it's usually those that we get the biggest challenges on, right? The standard ones there's usually no surprises in them.
Yeah.
It's the other ones that tend to bring up the most queries.
Yeah, the more complex they are, then more questions generally.
Yeah, for sure. Okay, that's fantastic. So we covered semi-commercial, and we've sort of touched upon commercial as a space as well. In terms of commercial, what specifically are valuers looking at in order to help the valuation? Now, we understand that you can asset manage a commercial space, so it's got stronger leases and that sort of thing. Do you just want to talk us through the difference, or how commercial is valued and how that ultimately differs from a residential?
Yeah, I think if a commercial property, so industrial, retail, office, if they're let to a strong covenant, then invariably the yield, the value of it will be stronger than something like a local covenant, for example. So it's how strong that income stream is. So if you've got something like for 5 years to Joe Bloggs, the value is probably going to be very similar to that of market to vacant possession value, because it's hard for, and I guess someone who's, again, I always come back to market value. What would someone buy for that property? They'd sort of see the risk in their income stream and say, well, that could drop off if the tenant failed, for example, and you're going to get it back as vacant. But if you've got a retail unit let to M&S for 15 years, then that's going to be far more valuable than it is if it's let to Joe Bloggs. So if that's a very extreme side of things, I think other things you look for is location, demand. Could you let it easily? A lot of properties are driven, the value is driven by the ability to rent something out and how much you can rent it out for. So locational factors, condition of the property, those kind of things. So it's the basics really. It's there's nothing magical around it. I think a good quality asset in a good location that's desirable to rent, to buy, good footfall, for example, of retail units, and the strength of the covenant. It's people are prepared to pay far more for those assets than sort of a tertiary industrial unit. It's again let for a couple of years to a small local covenant.
Yeah, and I think from our listeners' perspective, the appreciation and the difference here is that the demand for housing is at an all-time high, probably in so much that we're not building enough and so on. So that the market you're selling to is not strictly investor-led. So you're also selling to the home buyer and the home mover, which is a massive part of the market. Excuse me. Now, whereas commercial, unless you've got a trading entity that wants to occupy the property, owner-occupier, is primarily investment-led. So it will be driven very much by its income and who's going to occupy it and so on. That's why I guess we're looking at it in two slightly different views, because if you're going to sell it on, you're more likely to sell it to another investor who's going to have the same set of criteria as to, hang on, how much income am I buying and and so on and so forth.
Yeah, invariably, it's you can spin on its head. Some businesses really want to buy properties that they can occupy, and it's one property might be a great location for them. It might hit not be perfect for everyone, but might be perfect for them. So they might be prepared to pay a premium. I think it's important as well on this to not sort of go. I think bringing the HMO values into this, and what valuers value them for, that is a real grey area. But I think for me, I the rent and yield approach on HMOs, when a bed is in the lounge essentially, and it's simply a terraced house, the values can swing wildly. So I think I talked about before the investment value and the comparison method of rate per square foot. So most valuers will do both approaches. So they'll value it on a yield approach, for example, and then they'll compare it to a rate per square foot. So and both should give comfort to the number provided. So some lenders do have they have different sort of definitions of HMOs and how they want valuers to approach it. So some lenders do guide the valuers and how they want them approaching. It's surprising the differences you can get in the values, and really understanding, how a valuer is going to approach them, I'd say is really important, because so investors' expectations versus the reality. And I think, before you get into a HMO sort of scheme or conversion, it's getting a real grasp of those end numbers essentially, because you don't want to get caught out at the end, because it can stop you in your tracks of what you've got in the pipeline and that you want to do in the future.
Yeah, definitely, and that speaks to the fact you see more refinances than purchases on the HMO stuff. We are certainly seeing people acquiring units to convert them into HMOs with the view of increasing its value, recycling your cash as much as possible. And there is a big lean towards this yield-based valuation. And we have a lot of conversations with investors about, will this qualify for one and will it not?
Not a lot of them are selling either, so that even the valuer just doesn't have a huge amount of comparables to compare them to. So I think one thing you do have is a lot of C3 residential comparables on a rate per square foot, so you can get comfortable on that side of things. But I mean, property data is a good, I don't know if you come across property data, but they do a really good, you can put a sort of a radius around a specific postcode, and you say a 3-bed terrace that I've sold in the last 12 months, and they give a rate per square foot, lowest to the highest, and like a median, so you can get a really good tone for what things are selling for in the area. If a value's come out and it's off the Richter scale in terms of price per square foot, then what is the reality of that in the open market? Someone would actually buy it for that. And I think it's that, I'd sort of call it when we just spend a premium on it over and above a C3 value. And I think it's, it's Article 4 area. You've got a license, all en suites, all done in line with regs. The higher you are up to that standard, then the more likely you are to get that rent and yield approach. And people would more likely pay a premium for those, because they don't want the hassle of buying the 3 or 4 bed terrace and doing all that work, because there's a huge amount of work that goes into converting these things. But the average person wouldn't pay a crazy premium over the cost to buy it, the cost to do the work, and an element of profit, I suppose, and effort to do it. So yeah, that is it's a challenging space.
Yeah, but it's always, I've never truly understood how valuers find their comparables. For me, it seems as though it would make more sense that there's a database of all this stuff, which on straightforward resi sales, there is. You look at the price sold, data history. You can look at that HM land registry and just see what's gone in that. The yield stuff, though, is a bit more difficult. Do valuers then manually ring round agents? So how do they find the yields for these types of properties?
Some valuers might have an agency part of the business as well, so they'll actively buy and sell them. So they'll talk to their own agency team. They'll have their own comparables as a business. Yeah, some should be picking up the phone to people who've sold them to find out the details around them. So valuers do all the time call up agents to find out what things have sold for. That's backed up with land reg, but it takes a few months to record properly on land reg. In terms of comps, like you say, it is challenging to get them the Essential Information Group, EI Group. It's a really competitive subscription fee, actually, and it tracks everything that's sold in an auction across the whole country. So anything coming up in an auction's on there, so it's good to spot things you want to buy. It's got all the auctions in there across the whole country, so you might have a London-based auction, but there's properties up in the north there. And then that does have its gross yield, so it's the gross rent there, what it's sold for, so be able to give a yield as well. So that is a really good. So if any of you sort of people watching don't have access to that, I would definitely have a look into a subscription of that, because I think they'd find it quite useful.
Yeah, what was that called again? Sorry.
Essential Information Groups, EIG, I think. So if you Google it, so yeah, it tracks all the auctions of anything ever sold and anything coming up in auction as well. So it's a great source for finding properties to buy for investors, and it's a great sort of tool for comparable evidence for valuers as well.
Fantastic. I shall check that out.
Yeah, happily. I'll send a link over.
Okay, lovely. Thank you very much. And if anybody else wants to just drop us a message, and we'll happily share that as well. So, okay, fantastic. Yeah, HMOs, again, that's a topic that can realistically take a whole podcast, and surprise, we've done several of them already. So if you want a deeper dive into HMOs, then just have a listen to other previous episodes. You'll find plenty on there on that front. In regards to what you're seeing generally in terms of market trends, so I guess what we're looking at is volumes, historic versus where we are currently, and what you predict the market to look like going forward. What are you kind of seeing in terms of volume?
I think I wouldn't say we took a dip with the recent budget, but definitely more subdued in terms of volume, I think. And then it didn't help us because I think they announced it. I mean, it seemed to go on forever, didn't it? Was it 3 months before? So there's that massive speculation and uncertainty, especially around higher value properties. But then really that percentage, over on 2 million plus is quite small. Look at stamp duty payable on a £2.5 million property versus that the tax side of things. It's absolutely minuscule. But we did think that sort of side of the market was going to get harder than it has. That hasn't come out yet. But I think we definitely sprung back from the new year. That's definitely been, volumes are sort of back to where they were. Sort of semi-commercial side of things and HMOs definitely stuck in terms of the volume we're doing there. I think, if you'd look 5 years ago, the amount of development valuations we were doing, refurbishments, things like that, was way higher. I think people have been having a hold and wait to see what the government have done. My view is, this country only can do 150,000 resis a year. I think, we need 300,000. They've been saying what they're going to do to the planning system. I don't think we've seen it yet. I'm not sure if we're going to see it. We've got I could get me going on this one, but so we've had something like we've had 15 housing ministers in 18 years. So it's they're changing every sort of 14 months. So, but I do think what we're going to see is more development and things like that. I do expect that. And, I was only saying about 3 weeks ago, we just need a consistent year, really. And then obviously the last week or so, what you see in terms of the wider outside of the UK and what's going on, it's like, is that going to affect us? I'm not sure. But I think everyone's just craving a bit of consistency given, because this business has been going 10 years now, and what we've faced in that time, whilst growing a business, trying to scale it, give good service, good reports, plus all the stuff that's happened in the world. It's been crazy, really. But I do think, like I do say now, I think we are living in a more uncertain world. And before 2008, it was a cyclical 10-year property cycle. There was loads more consistency, but we are in an uncertain world now. And I think these kind of things, we have to be resilient as businesses to be able to, absorb these shocks, which is, is happening all the time, isn't it?
Yeah, and I think absolutely. With the good thing about property, though, is certainly on the residential and the investment side is, on the basis we can't build enough homes, there's always going to be a demand of some description. Now, you may not like the regulatory obligations and that sort of stuff. That's now part of the business, as opposed to 15 years ago where, standards have risen, and that's a good thing, as much as, some people don't like it. And I think we're also, some of these things that we're experiencing today are still, there's a lag in the system from, so you spoke about the HMO refinances being stable. That's probably, or it could well be driven by the fact that they've taken short-term debt to do that, and they have to refinance anyway. So it doesn't matter what the market does. They there's an event-driven activity there, which is you've got to get out and you've got to do it. So I think in 18 months' time, it'll be interesting to see what that actually looks like and how many people slow down in this period
as we track it. But I think that, look, the UK property market is it is a more stable market. I think, I had a bit of a laugh. The conversation the other day say, how long the whole process is of, being able to buy and sell a property, but actually goes in our favour. If you see, as soon as the market dips, the property REITs, they crash massively because people lose confidence and pull the money out. But if you said, the property market's dipped, I'm going to sell the property, then, you do well to get it gone within 6 months. And within 6 months, the property will come back. So you never sort of see comparables go up and down so heavily because the market, it takes so long to get these comparables. But if you compare it to Bitcoin and cryptocurrency, it's, if a high profile person said crypto was rubbish, the thing had dropped 25% in a day. But if that same person said the UK property market is rubbish, everyone would just laugh at them because they know it's not. So it is a very stable place to have your money, I think.
Yeah, definitely. And that is, I guess, the attractive nature of it. So it's easy to leverage against property. I say easy, it's easier to leverage against property. And it's got that stability in there. We rarely get 25% fluctuations. Yes, even in 2008, there were pockets that got hit hard, and yes, appetite reduced. But conversely, we saw the complete opposite happen in COVID. It's difficult to say, how these macroeconomics will actually impact the sectors that you're in. So
no one sold anything in COVID. I think you had like nightclubs, you had things like that really, really struggled. But like nothing, we were temporarily propped up by the furlough scheme. So it was you never really saw comparables that proved that we just saw volumes drop off. Obviously, didn't we, off a cliff? I never thought in a million years on that 23rd of March, Boris would have said, well, a lot better, because I knew the property market would just stop. But I mean, it sort of, everything bounces back quite quickly, doesn't it?
Exactly. It's where there's demand, it'll always come back on that front. And then you mentioned HMOs, so the types of instructions we've touched briefly upon semi-commercial, less so on the commercial. Do you see that trend becoming a thing in terms of the future, that people are going to continue looking outside of just your traditional buy-to-lets?
I think so. I think there's still huge, absolutely massive demand for the rental market. We've seen this renters' rights bill coming in to sort of try and protect tenants, which I think is a positive thing, if I'm honest with you. I think there's nothing in there that really is shocking, in my opinion. It's just sort of it's doing things properly, isn't it, as a tenant? But so I think the HMO side of things will continue to be popular because, like I say, tenants need a place to live, essentially, and even rents are so high now. So I think house of multiple occupation will remain popular. And I think, it's just a fact. We need to build more to satisfy this demand. So I think, more developments, more HMOs. I don't think, so from the office side of things, I think that working from home side of things, I think people do want to go into an office now. So I think offices and smaller offices in particular, remain quite popular. A lot of the offices in certain areas were converted to residential anyway. So there's not a huge amount of stock on that side. Retail is interesting. I think we always talked about sort of retail and wider CBDs contracting and, conversion of that. I think there's a lot of empty units still around. I think you've got to be brave now to set up a new business. It's a lot more e-commerce type businesses and service type businesses, but, rates, shops, I think that's a problem. The government definitely needs to look at that rate side of things, but I can't imagine them doing anything anytime soon. But I think that the challenges remain in that sector for sure.
Yeah, and without getting political, it's a place to tax that keeps the voters on side so that they can keep winning their votes. And it's almost like a tax that they don't have to pay in a sense. So that's there. And then the commercial side is interesting, actually. I think this sort of spun out through COVID as well, was those that did well in the commercial space through COVID, I say did well, didn't get burnt in this commercial space, with those that had the smaller units, those that could tolerate the pop-up shops, the smaller industrial units where you had your startup, we didn't need 10,000 square foot, and they could, just needed a small as I say, e-commerce business, somewhere to drop ship or whatever they had to do and that sort of stuff. So, and similarly with retail spaces is the smaller retail space, so that, if your tenant did cease trading, it's relatively easy to backfill.
Yeah, that you can rent it again now tomorrow. Whereas if you've got a much larger space, much bigger challenge to try and get that away. I think I was talking to an economist the other day it was quite interesting. And his view on stamp duty was, if you just got rid of stamp duty for first-time buyers and stamp duty for over 60s, this whole market would get moving again. And I thought that was a brilliant idea. But I think we need to see some sort of ingenuity from the government again. But whether we get it or not, I'm not sure.
Yeah, unfortunately, policies are made for terms that you're serving rather than the longer term future, and they need to see results much faster. So,
well, if you look what Osborne did, when he was in power, and that was all aimed to stop more landlords get people on the property ladder, but it didn't really stop, did it? Like, people still want to buy property and invest in it. So it's, I think, doing more to support that world. Personally, I think would be better.
Yeah, and like whilst I think from what we're seeing for sure is those that have been in property for a long time, pre-2008 and so on, are probably the ones that are most vocal about the changes in the regulations that we see, probably because they remember a time when it was a lot more straightforward. Those new entrants into the space know no different. So they join in the game, and the rules of the game are what they are. So we find far less resistance to new entrants, because, as you say, they have nothing to bench it against. Those are the rules, and that's what you've got to do. So we do see that a lot.
We think if you get them externally managed as well, then it's their responsibility to be up to date with all the rules and regs, isn't it? It's and to guide and to sort of advise the person that owns them. If you're managing it yourself, then the onus is on you, isn't it, to make sure you're definitely up to speed with all of that.
Yeah, for sure. Okay, well, fab. No, I think that's been really useful. A really good insight there into the valuation process and valuations and just how things are perceived, because I do see that not everyone, but we certainly have but there's never a problem when the valuation comes in and meets expectation. There's only ever pushback, obviously, when the expectation doesn't meet the value that comes back. Those conversations then can become challenging. For obvious reasons, but there's a process that we can do to obviously push back, so it isn't valuer says no type thing. There is a process we can go with, and as long as you've got the evidence to back it up, you can push back a little.
At VAS, we've got a sort of a team of chartered surveyors within the business, so I think being able to, when we do get these challenges in, to be able to understand them, and if a valuer has made a mistake, we can work with the valuer to try and rectify it. If the valuer's right, and we've been asked a question from a lender or broker or customer directly, which we think is wrong, we can sort of support the valuer, but sort of interpreting the problem and being able to, and there's absolutely nothing we probably haven't seen, so it's like being able to interpret that quite quickly and deal with it properly and get a positive response, even if it's not what the customer wants, but a positive, quick response. It's better for everyone, really. So I think we're well versed at dealing with that, and it comes with the territory, doesn't it? Every property is different and every scenario is different. So I think if you're surrounded by people who've got lots of experience and know they're doing and know the markets and everything, it's really important.
Yeah. Okay. Well, no, I just want to say, thank you very much for your time, Stephen. It's been really insightful. Really enjoyed having a chat around it. Valuations will always be a bone of contention when they don't quite go your way, and I don't think that's something that will ever get done. But hopefully this is a bit of insight to our listeners as to the complexities that sit within it. It's not as straightforward as ticking a box and just giving a number. There's a lot that goes into actually writing valuation reports and the process and the thinking that goes into it. So there's no doubt that people's opinions will differ on the values of stuff, even if you get the same instructions. So thank you very much for that. Really appreciate your time.
Thanks for having me on.
You're very welcome. Speak to you soon.
Thank you so much for listening to our podcast. We hope you have learned something and have some tips to take away. We'd be very grateful if you enjoyed the show. You could give us a review and share with anyone that you know that may be interested, and of course subscribe to the show so you can get notified when a new episode is released. If you'd like us to answer any questions or go deeper on a specific topic, please drop us a message at primeproperty.finance. See you on the next episode.